Hey, this is Mike Swanson. I'm here with Dave Skarica, and we're actually in Myrtle Beach, South Carolina. We were up in Washington, D.C. the other day and decided to take a trip down here too for a couple of days.
Yeah, and we're in D.C. and it's interesting because we're there where like the government is essentially, and that's where I guess a lot of the problems are coming from right now with the deficits and the spending, and you can see it like the sizes of some of these federal buildings and whatever. And you know, there's this big talk right now about quantitative easing and QE3 and all that sort of thing. And
well, there's a lot of speculation whether it'll happen or not, because this quantitative easing, you know, the stock market's gone up ever since they announced it last August. So people are wondering, are they going to do it again, help things go up even more?
But I think what's happening is, even though the market's gone up, there's a lot of criticism that really unemployment situation hasn't changed and resource prices have gone up. You know, the agriculture.
Well, people wonder what good has it done.
Because what they're thinking is it might have caused more inflation than it did, like, you know, more bad than good. You know, like gas prices going up and agricultural prices going up. And some people would argue, and I would agree with them, that that has a lot to do with what's going on with the tension in the Middle East. That a lot of it is because people can't pay for food. So what happens when you pay for food? You know, you get angry, and if you have a dictator in charge, you kind of look to overthrow him. So a lot of people have, you know, discussed kind of the negative aspects. But one of my arguments is, I kind of think unless at the fiscal part of it, you know, changes, they kind of have to do it. Because if you look at the numbers, there was about $500 to $600 billion of buying at the private level, and about $500 billion of foreign central banks or foreign, you know, countries buying. So that comes to about $1 to $1.2 trillion, and the deficit this year is going to be $1.65 trillion. And you actually issue more debt because of interest and whatnot. Like last year, the deficit was 1.4, but they actually issued, I think, 1.5 trillion. So you have this $500–600 billion that's unaccounted for. That basically there's no demand. So what's the easiest way is the Fed essentially makes up that lack of demand. So unless I think the deficit situation changes. Okay, they may not do it at first, but I think they're going to be forced to do it down the line, or maybe they do it but they're not as upfront about it.
Well, what's going on when they do this quantitative easing, the Federal Reserve is buying Treasury bonds.
Yeah.
And they announced that last year, and the reason they said they're doing it was to help stimulate the economy and keep interest rates low and so forth. And what you're saying is that they basically are going to have to do it, not for those reasons, but because we got such a big trade deficit, and so many bonds need to be bought, not enough people are buying them, so the Fed has to step in.
Yeah, I think that's part of the reason it's been done anyhow. I think they'll say, oh, yeah, we're doing it to stimulate the economy, but they know the numbers, and they kind of look at it and say, you know what, if we weren't doing this, okay, there's a sell-off of bonds, you know, since they started it, but I think they would know that, remember, bonds were rallying in anticipation of them doing it, so that discounted interest rates already happened.
Well, let's assume they do another one. What effect do you think that'll have in the stock market and gold markets?
I think in the stock market, at some point, it's going to lose its effect. I think people are going to say, well, this isn't really improving the underlying economy. Okay, the Dow and the S&P can go up because of liquidity, or they can go up because increased profits of corporate, you know, like national companies and you know, multinational companies. But at some point, you need the unemployment rate and real domestic demand in the economy to occur, and I don't think that really is. Like, if you look at Japan, Japan's been deleveraging at the private level for the last 15 years. So I think that's the situation we're in the States. So I think at some point the stock market won't respond positively to it, and all it will do is essentially debase the currency and will cause the U.S. dollar to go down, a loss of confidence in the dollar, that they have to keep printing money to buy bonds. And it's kind of like the Iraq War in that, you know, Dick Cheney has this one line that there's really no exit strategy. That's kind of what it is with the bonds. Like, after they buy all these bonds, what are they going to do with them? Like, they're not going to sell them, because then that make interest rates go up even more and the bond market tank. So they're kind of stuck with them. So I think that there's no exit strategy as well, and they kind of have to continue buying. My opinion is they will announce that they won't do it, and then, you know, you'll see a correction in the stock market over the summer, and maybe a correction in some of these commodities over the summer, and then when that happens, they'll get worried about deflation again. And even if they don't announce it, they'll do it at some level.
Well, a lot of these big themes you bring together in your book, The Great Super Cycle. Are you still doing this deal with the book?
Yeah. What's interesting about my book is I talk about we're in a long-term cycle of rising commodity prices and lower U.S. dollar. What's interesting is I talked about this way before these quantitative easings were even taking hold and the whatnot. You know, I've been talking this, like, the theme of it for the last 5 or 10 years, and I talk about it in the book. Yeah, and we have a special deal with the book if you're interested in, you know, the dollar devaluation and higher commodity prices and why this is happening and why the stock market hasn't gone anywhere in 10 years. My book, The Great Super Cycle, talks about these cycles and why markets travel in these cycles. And we have a deal that if you buy a copy of the book off Amazon or at Barnes & Noble, or actually, because Borders is going under, you can get them at a discount there. If you do that, you can just send us me your email, and you'll get 3 months for free to Addicted to Profits. And then in 3 months' time, we'll blast you an email, and if you like to subscribe, you can. So yeah, buy a copy of the book. You can sign up for 3 months, and we help you. And it's the full newsletter for free for 3 months.
Well, thanks for listening, and we'll be talking to y'all later.
Yeah, take care.